In this video, we'll explore about futures contracts for hedging, speculation and arbitrage. You can think of derivative instruments like futures and options as tools that were originally created to help people manage financial risk. Today, these instruments are widely used for three main purposes, which are managing risk through hedging, using leverage to trade based on market views through speculation, and profiting from price mistakes through arbitrage. Let us start with a long hedge using stock futures. Imagine you want to buy 1500 shares of a company called ABC Limited. Today is May 10th and the shares are trading at 455 rupees. You have a problem because you do not have the money right now, as your funds will only be ready on June 20th. The risk you face is that the share price might shoot up rapidly before you can buy them. To solve this, you take a long position in a futures contract today that expires on June 29th. The futures price is 457.30 rupees, and since the lot size is 1500, you buy exactly one lot. Now, let us see how this hedge works when June 20th arrives. If the price has risen to 520 rupees, the shares in the cash market become expensive, costing you 7,80,000 rupees. However, your futures position gives you a profit of 95,850 rupees. When you subtract this profit, your net cost is 6,84,150 rupees. If the price instead declines to 390 rupees, the shares are cheaper to buy, but you face a loss of 99,300 rupees on your futures. In both scenarios, your effective price per share remains around 456 rupees. This proves that by using futures, you have eliminated the price risk and locked in your purchase cost. Next, we look at a short hedge. This is useful when you already plan to sell shares at a later date. Imagine it is May 10th and you want to sell 1200 shares of PQR Limited on July 10th. The current price is 1690 rupees, but you are worried the price might fall steeply before July. To protect your selling price, you look at the July futures price, which is 1706 rupees. Since the contract lot size is 600, you decide to short two contracts to cover your 1200 shares. Let us see the results in July, regardless of which way the market moves. If the price falls to 1440 rupees, you receive less in the cash market, but you make a profit of 3,18,000 rupees from your futures. This brings your total realized amount to 20,46,000 rupees. If the price rises to 1,800 rupees, you get more from the cash sale, but you face a loss of 1,15,200 rupees on the futures. In either case, you have successfully locked in a selling price of approximately 1,705 rupees per share. We can also use index futures to hedge an entire portfolio. Suppose you own 15 different large cap stocks worth 90 lakh rupees. Because your portfolio is well diversified, your main concern is systematic risk, which is the risk of the whole market crashing. To protect yourself, you can short index futures. To calculate how many contracts you need, we use the hedge ratio formula, beta multiplied by the portfolio value divided by the futures price times the lot size. With a beta of 1.3 and an index price of 17,700, the math tells us to short 13 contracts. This shields your portfolio from a general market downturn. Moving on, futures are very popular for trading and speculation. If you have a bullish view and expect prices to rise, you take a long position by buying futures. If you have a bearish view and expect prices to fall, you take a short position by selling futures. The biggest advantage here is leverage. It allows you to aim for much higher returns while using a much smaller amount of capital compared to buying the actual shares in the cash market. Let us compare the cash market and futures market for a bullish trader. Suppose you expect a stock to rise from 1298 rupees to 1350 rupees. In the cash market, buying 850 shares requires over 11 lakh rupees and results in a return on investment of 3.62%. However, in the futures market, you only need to provide a margin of 2,21,000 rupees. While the total profit is similar, your return on investment in the futures market jumps to 17.69% because of the power of leverage. Now, let us look at a bearish view where a trader expects RSB Bank to fall from 1,595 rupees to 1,520 rupees. Even without owning the stock, you can short the futures at 1,602 rupees by paying a margin of 1,76,220 rupees. When the price falls, you cover your position by buying it back at a lower price like 1,527 rupees. This results in a gain of 41,250 rupees, which is a return on investment of 23.41%. This shows how you can profit in a falling market without owning the asset. Another sophisticated use for futures is arbitrage. This involves calculating the fair futures price by taking the spot price and adding the cost of carry. We then compare this fair price to the actual traded price in the market. If the traded price is higher than the fair price, the futures are overpriced, and we perform a cash and carry arbitrage by buying the stock and selling the futures. If the traded price is lower than the fair price, the futures are underpriced, and we perform a reverse cash and carry arbitrage by selling the stock and buying the futures. Let us look at a cash and carry illustration. Stock A has a spot price of 1,500 rupees and a futures price of 1,550 rupees. Based on the cost of carry, the fair price should be 1,534.13 rupees. Since the actual futures are overpriced, you buy 100 shares and sell one futures contract. After accounting for a financing cost of 3,413 rupees, you are left with a net risk-free profit of 1,587 rupees. In a reverse cash and carry arbitrage, we look for underpriced futures. Imagine stock B has a spot price of 100 rupees, but the futures are trading at only 90 rupees. To profit, you sell 200 shares in the cash market and buy one futures contract. This gives you an initial arbitrage profit of 2,000 rupees. When we add the interest earned on the money from your sale, which is about 150.56 rupees, your total gain becomes 2,150.56 rupees. We also have a strategy called the calendar spread. This involves arbitrage between futures contracts that have different expiration months. The main rule is to buy the contract that is underpriced and sell the one that is overpriced. For example, if a stock is at 120 rupees, the near month futures might be overpriced at 121.30 rupees, while the mid month futures are underpriced at 121.50 rupees. You would then sell the near month and buy the mid month to capture the price difference. Finally, it is important to understand that calendar spreads are low risk and low return strategies. If the stock price closes at 122 rupees, you might have a loss on your short position but a larger gain on your long position, resulting in a net gain of 0.62 rupees. Even if the price closes at 120 rupees, you still see a net gain of 0.60 rupees. Because you have opposite positions in two different months, you are not betting on the market direction, you are simply capturing small mispricings that the market eventually corrects.